Hello, everyone. My name is Jay Personius, CEO of South Silver Group and the fund manager for the SSG Recreation Fund Number 1. During this brief video, I'll explain why we believe the marina space is the next wave of high return investments in real estate, share some important information about how to invest in this space, and share why now is a great time to consider investing in marinas with us. A link to our website is provided at the end of the video, where you'll find this slide deck, a link to my calendar to schedule time to chat and answer any additional questions you may have, and other important investment documents. So to get us started, I'd like to provide some context as to what's so special about marinas and why we believe marinas are the next wave for high return investments. Probably the most important answer is that the asset class is very early in its consolidation cycle. Of the nearly 10,000 marinas in the United States, more than 90% are owned by small businesses and mom and pop shops, which means that they are privately owned and operated and have not yet been absorbed by investors like you and I or by Wall Street funds. As such, these unabsorbed assets can typically be purchased at higher cap rates, which also correlates to higher cash flows up front. For those that are new to cap rates, it's the net operating income, or NOI, divided by its valuation. Using NOI along with cap rates is one of the easiest ways to assess the performance and value of an asset. As a simple example, an asset valued at $10 million with an NOI of 10% means that it's generating about $1 million in net operating income. Said another way, the NOI is 10% of the value's asset, hence a 10% cap rate. Now, if a new buyer is willing to buy the asset at a 7% cap rate when we bought it at a 10 cap rate, that means that the $1 million NOI is now considered to be 7% of the value of the asset, which in our example translates to a valuation of $14.2 million. That is a 40% increase in added value for the same NOI. Therefore, buy high, sell low is desired when it comes to cap rates. As markets get compressed, its cap rates tend to get lower, which is good if you're ready to sell, and even better if you were an early investor in the market's initial consolidation phase. Now, cap rates for an asset are affected by multiple factors, but a deeper discussion is beyond the scope of this current presentation. Consider scheduling a call with me if you'd like to go deeper into this topic. There's also an article on our website that provides an introduction to this topic. Now, the second reason we believe marinas are the next wave of high return investments comes from the benefits of building portfolios of like-kind assets. Now, there are several benefits that come from owning multiple marinas, including such things as discounts on insurance, which begins to happen when we own 3 or more of them, simple diversification of risk, stronger relationships with our contractors, consistency and efficiencies in operations and procedures, credibility in our relationships that come from our experience, and leveraging our lessons learned across multiple assets. As an example, our experience in converting mom and pop style bookkeeping to the compliant, generally accepted accounting practices, or GAAP accounting, at one marina easily applies to future marina acquisitions. Having GAAP compliant books is especially important when it comes to selling the portfolio at a later date. Such practices also work towards increasing the NOI, and as NOI increases, distributable cash flow typically increases as well, as does the overall value in each asset. For example, increasing the NOI by $10,000 when the cap rate is 10% means one has just added $100,000 to the value of the asset. Now, when selling marinas in a bundle, the merger and acquisition effect, or M&A effect, kicks in. Portfolios of optimized operations and diversified risk appeal to larger investor groups who are willing to pay a premium by accepting lower cap rates for already having all the nitty-gritty taken care of. Now, combine that with an improved NOI through expense reductions and added revenue, and you can see how nicely value can be added to the original investment. Now, one would naturally ask, is a decrease in cap rates like this really achievable? And the answer to that question is an emphatic yes. At the time of this recording, our team has been able to acquire 6 marinas at cap rates of at least 9% and higher, and we are already seeing parties interested in buying our first marinas at just above a 7% cap rate. Now, once a portfolio of assets has been collected and optimized, larger funds become very interested. As more and more marinas become acquired in this way, cap rates will begin to consolidate or become compressed towards lowered percentages. So it's best to be a part of this wave early on. Other familiar asset classes easily demonstrate this cap rate compression. For example, multifamily assets are typically purchased these days at around a 6 to 7% cap rate, while cap rates for self-storage in Texas are typically in the 5 to 6% range when they used to be closer to a 9% cap rate a decade ago. As middlemen investors, we're able to bring in new capital to these assets, use creative financing, and implement a host of other techniques that make these assets attractive to lower funds. A third reason marinas are a new wave of high return investments is due to the dynamics of the seller base. As I've already mentioned, most of the marinas in the U.S. are owned by small businesses and mom and pop shops. Many of them have been in the family for decades, and most operators aren't going to pass them on to the next generation. This is partly due to the next generation's disinterest, but it's more so due to the fact that the current owners want to pull out their equity for retirement. While there are various creative financing options that could be used to pass on the marinas, the disinterest of the next generation simply leads to the easier option of just selling it. Another seller dynamic worth noting is that many operators have chosen to keep slip and pad rents below market value out of a fear of driving away clients, their friends, and thus they don't have the capital to improve the asset, expand it, or in some cases, even maintain it. This type of operator simply doesn't press forward with the best practices from a business mindset, like raising rents until you see a slight drop in occupancy. And many simply haven't done the best job at leveraging social media to keep up occupancy and visibility. So at the moment, with so few marinas being managed for scale, there's a great opportunity to be part of this transformation. Now, finally, as an asset class becomes more popular, the window of opportunity changes for investors. Limited partners can usually get better returns if they are early in the consolidation phase. Then over time, as assets are optimized or portfolios get larger, large private equity firms and larger funds buy out the middlemen like us at lower cap rates. We believe there's about a 5-year window for this kind of opportunity that's before us today. Now, historically, marinas simply haven't been on the investor's radar as they have been focused on more familiar single-family, multifamily, and self-storage asset classes, for example. But that has changed. Larger funds are now seeing marinas as a viable complement to their alternative asset class portfolios. The most recent affirmation of this positive shift towards marina investments came from Blackstone's recent purchase of Safe Harbor's 138 marina portfolio for $5.65 billion in April of 2025. To assist you in getting acquired with the marina space, here are the main characteristics of marinas that can help in understanding this investment class. These are obviously things that a good management team must monitor and respond to in order to properly operate the assets. The clientele in the marina space typically has a higher net worth and higher incomes, well above the $100,000 a year, which is different from your average multifamily resident. While their spending and discretionary income is still impacted by economic swings like everyone else, it tends to have a less volatile impact on marinas since they have a slightly higher income to begin with. Folks with boats will still use them in hard times simply because they are there, although they may use them less often. Selling a boat at a loss and then having to pay a premium to get one back once the economy turns around is very costly. Therefore, owners have a tendency to simply hang on longer and try to ride out economic churn. And since the boat slips at well-run marinas typically have a waiting list, boat owners would rather hang on to their slip lease even if it's tight financially. Well-managed marinas also have higher retention. Many marinas, especially ours, average well above 97% occupancy for boat slips, and we often have extensive waiting lists. The alternative to renting a boat slip is to rent dry storage, but this requires insertion and extraction for each use, which is less convenient for the boat owner. Boat owners who live in HOAs are usually forbidden from keeping their boats parked at home. Thus, the availability of a boat slip or dry storage unit props up the demand for services at the marina. When it comes to operations, marinas usually have multiple diverse streams of income which must be managed well. It's not uncommon to have at least a dozen forms of revenue, while multifamily and self-storage, by comparison, are far more limited in this respect. Having multiple revenue streams enables us to capture all the angles of what people would like to spend their fun money on while at the lake. Many marinas also have RV pads for rent, so that clients don't have to go back and forth to a hotel or a home in order to enjoy an extended time at the lake. These RV pads are usually leased annually, as clients would like to come to the lake whenever they feel like it, and it allows them to better adapt their plans to favorable weather conditions. And while the clients may not be there every day, we are still collecting rents regardless. Besides boat and RV rentals, other examples of revenue streams at a marina may include fuel and ship store sales, food and alcohol sales, repairs and maintenance, boat storage, houseboat rentals, water equipment rentals, boat club memberships, Wi-Fi services, parking, ramp fees, clubhouse rentals, boat sales, equipment sales, and more. Long-term leases provide for year-round cash flow. We lease boat slips and RV pads annually, and this helps us to reduce our administrative overhead and marketing expenses in order to maintain that occupancy. It also provides steady cash flows in the off-season, and it's more convenient for our clients. Our aim is to have a significant portion of our overall revenues come from just long-term leases. Now, seasonal swings are a factor that must be managed, especially for boating activities. Income during the off-season is definitely lower, but the revenues still produce wonderful NOI on an annual basis. The biggest influence in is the timing of the school year, which dictates the available window of time for family vacations. In the U.S., seasonal temperatures and weather are a close second and will vary by geography. The northern areas will get cooler sooner than lakes that are in rivers that are in the south, which shortens the season a bit. And northern areas above the freeze line will require boats to be placed in dry storage for the winter. Other geographical factors, such as inland versus coastal waters, come into play, where oceanic weather can also be much more severe. Man-made lakes, especially, have additional governing authorities outside our control, which can impact water levels and may have access restrictions at times. For acquisitions, we're looking for marinas that have an existing high NOI, but have expansion opportunities and are lacking in operational efficiencies, which offer us the opportunity to lower our expenses. Many of the marinas in the U.S., and especially the ones we consider for acquisition, have rents well below market rates because owners haven't managed their assets to scale, which also means many of them are short of capital for improvements. This gives us an opportunity to add or raise rents, especially when there's already a waiting list for boat slips or RV pads. Expanding existing marinas is relatively low-cost investment to create new revenue. By increasing NOI through expansion and the things I've already mentioned on the previous slides, we can significantly increase the value of our portfolios. Building a new marina is not currently part of our business plan, since there are plenty of marinas that have already successfully navigated the permits and environmental hurdles to get started. The complexity of multiple revenue streams, the requirement for management skills in many areas, and the capital required to make an acquisition forms a higher barrier to entry, which tends to reduce our competition. Marinas have significantly more business-like operations to them than residential real estate or storage. The combination of the various revenue streams I mentioned requires a team experienced in different markets and handling seasonal dynamics. Besides of all the business aspects of running a marina, there are also those jurisdictional entities that need to be navigated, such as the Army Corps of Engineers or the Tennessee Valley Authority, just to name a couple. This is where our team is already ahead of the game. We now successfully have managed multiple marinas in multiple states, have navigated multiple forms of acquisition, including 1031 exchanges, worked with various jurisdictions, and have been operating for several years. Now, understandably, marinas, being out of doors, have a special appeal to millions of Americans. They provide a great way to have fun and relieve stress. Now, marinas are also acknowledged as having good recession resistance for a couple of reasons. Namely, as mentioned earlier, the higher net worth of the clients and their tendency to hold on to their boats and RVs during economic downturns. As depreciating assets, owners tend to keep them as long as they can during economic uncertainty. During COVID, cabin fever and social distancing requirements drove a huge wave of people to the outdoors. Boats and RV sales went through the roof, and occupancy rates shot up to new highs. These pumped up sales have since reversed and are now back to and even exceeding pre-COVID levels. As for the marina market, according to IBIS World, the U.S. market is now $7.6 billion annually, which represents all related revenues, not just the value of the marinas. As mentioned, more than 90% are owned by mom and pops and small businesses. The U.S. compound annual growth rate is about 2.4%, while the global compound annual growth rate of marinas is 6.23% per year and is projected to grow from about $17 billion in 2023 to over $23 billion in 2028. The number of marinas in the U.S. is just shy of 10,000, depending on who you ask and how they are counted, which is a slight decline of about 1.8% between 2019 and 2024. This slight downward trend tends to create a slightly higher demand for slips at existing marinas. This presents the opportunity to increase NOI by adding slips to existing marinas. Those who engage in boating in the U.S. annually number about 100 million, according to the National Marina Manufacturers Association, with younger boaters preferring to rent boats and equipment when compared to older boating adults. Marinas also have a very high profit margin of around 18% and typically have high occupancy rates due to the shortage of available slips for rent. Herein lies our opportunity to take advantage of existing wait lists by adding those extra slips, which is much easier for us to do as new buyers with our investment capital than for existing owners who haven't been raising the rents enough to do it themselves. And now, as I've mentioned, Wall Street and private equity are getting serious about marinas as part of their alternative asset class portfolios, as evidenced by the Blackstone purchase of Safe Harbor's portfolio. Any successful investment endeavor requires a strategy, of course, that fits the opportunity. For us, that strategy begins by culling our pipeline of available marinas on the market. The saying, "you make your money on the purchase," is absolutely true. So our team has a set of criteria we use in our pipeline of potential acquisitions. Now, we don't share the exact specifics of our criteria publicly, of course, but it is serving us well. Obviously, though, this will take into consideration current financials, the current number of slips, occupancy rates, which revenue streams there are, and examining the potential for increasing the asset's NOI through expansion, standardization, and operations to the ability to lower expenses. Our strategy then looks at the possible profits that may be gained through putting together a portfolio that is attractive to larger private equity or Wall Street. We practice horizontal integration, the buying of like-minded assets, to realize cost savings, and we benefit from the natural diversification of holding multiple assets in different geographical areas. Then we apply our experience across multiple assets so that we're not reinventing the wheel. It's a simple concept, but the profit is made in the execution, of which we have several years of experience. I hope this initial but brief material has helped you in your understanding of the marina market. I'd now like to introduce you to our current investment opportunity, but first, an important disclaimer. The following material is for information only. The actual offering is only available through the private placement memorandum and is for accredited investors only. Investment documents and other information are available on the investment page of southsilvergroup.com. Any financial information presented here represents assumptions and projections. Actual results will vary and no guarantees are being made. No one on our team is a financial advisor, and each investor should consult their own professionals for advice. We trust that the following details would stimulate conversation and personal research before anyone makes a decision to invest. The offering we presently have open is the SSG Recreation Fund number 1, or RecFund for short, and as mentioned, is offered to only accredited investors. It's structured to be a fund-to-fund model that provides equity into other target funds that project at least a 30% internal rate of return at the time of exiting the investment and provides at least quarterly cash flows during the holding period. Now, since the Rec Fund is a fund of funds, it must legally provide each investor a better position than if they were to invest directly into one of the targeted funds. In order for this to work, the targeted investments of the Rec Funds will need to have at least a 3-tiered investment ladder that resembles the following. Tier 1 would be for investments of $50K to $249K, where investors receive an 8% preferred return with a 65% limited partner to a 35% general partner split. Tier 2 would be for investments of $250K to $499K, where investors receive a 9% preferred return with a 70-30 split. And Tier 3 would be for investments of at least $500K, where investors receive a 10% preferred return with a 75-25 split. The SSG Rec Fund combines capital from investors who desire to invest less than the $500K and invest it when the Rec Fund invested at the 3rd tier level, where the 10% preferred return and the 75% equity position comes back into the Rec Fund. The preferred return for tiers 1 and 2 will be passed directly to the Rec Fund investor at 8 or 9% respectively for their similar investment levels. But to make this a better deal, the Rec Fund investors will receive a higher equity position than if they had invested in the target funds directly. This is accomplished by the Rec Fund passing on 94% of its equity position to A2 class investors for $50K plus investments, or 97% of its equity position to A1 class investors for $250K plus investments, as noted in the middle of the slide. This results in the Rec Fund investors ending up with a 70.5% share for A2 class investors, which is 75% times 94%, and a 72.75% equity position for A1 class investors, which is the 75% times 97%. If any Rec Fund investor wishes to invest $500K or more, please let us know, and we'll get you directly into one of the targeted funds instead, since the Rec Fund will not be able to give you a better deal than investing directly at that fund. Please work through us at South Silver Group to get that referral. We would appreciate it. The difference between the Rec Fund's position and the targeted funds at 10% preferred return and the investors' 8 or 10% preferred return enable the Rec Fund to pay its expenses by sharing a difference of the 2% or 1% respectively. As additional funds are contributed to the Rec Fund, they are invested in target funds to acquire additional equity so that its investors are not diluted by new capital coming in. Distributions for the targeted funds will generally arrive in the Rec Fund investors' accounts between 45 and 60 days after the end of a quarter. Our expected hold time, while dependent on the targeted funds, should be about 3 to 5 years. The first targeted fund was the NH Marina Fund 1, which is now closed and has 3 marinas under its management. Stardust Marina in Tennessee on Norris Lake, Mermaid Cove in Missouri on Lake of the Ozarks, and Kotawa Harbor in Kentucky. The second targeted fund is the NH Marina Fund 2, which is still open and has its first marina under contract. At least one other marina is expected to be added soon. The Rec Fund will likely close after the NH Marina Fund 2 closes. We'll consider whether or not to open another fund at that time. By way of full disclosure, South Silver Group is a general partner in Windlass Marinas, also known as New Haven Marinas, and the SSG Recreation Fund. By being a partner in both, we are able to provide this additional benefit to investors investing less than $500K. Our mutual investment thesis is to acquire marina assets in the U.S., inland, freshwater, from independent business owners, mom and pops. We will be buying at higher cap rates and then optimizing, expanding, upgrading, and operating them in order to sell at a lower cap rate after applying our strategies to raise NOI and combine assets into portfolios. New Haven Marinas is now in its fourth year of assets under management and has completed the acquisition of 6 marinas with another under contract at this time. Norris 2, our original acquisition, consisted of 2 marinas, which, by the way, are not in the funds. We closed on this purchase in August of 22 and have delivered 80% of its preferred returns to date. It continues to distribute returns every quarter and is on track to be meeting its original projections of around 30%. NH Marina Fund 1 has been making distributions since May of 25. Distributions are still ramping up as the 3 assets were acquired at different times, while each investor's preferred return continues to accrue since the day they invested. NH Marina Fund 2 is now under contract to acquire its first asset with a potential closing date before the end of 2025. As a special note of celebration, Stardust Marina on Norris Lake has been voted the #1 marina on Norris Lake for 2 years in a row. For context, Norris Lake has at least 20 marinas on its shores. And Mermaid Cove was also voted as the #1 marina on Lake of the Ozarks this year. The team has excellent legal counsel, outstanding leadership, and is experienced in multiple forms of acquisition, such as syndication, fund models, 1031 exchanges, and asset purchases. We are already working with private equity for both the purchase and potential sale of some of our marina assets. We're currently entertaining interest from several buyers on our earlier acquisitions, but we must withhold the details at this time. That said, we expect to meet our financial projections. For those of you who are accredited investors and would like to invest, simply begin with conducting the personal due diligence you need to ensure this is a good investment for you, your goals, your risk tolerance, and your financial situation. We're here to help answer any questions you may have and point you to additional resources. The southsilvergroup.com website has articles, legal documents for your review, pitch decks, etc. Secondly, let us know when you want to subscribe by sending an email to investing@southsilvergroup.com. Rebecca, my business partner and daughter-in-law, will assist you in our process. Third, create an investor portal account. See the link at the top right of our South Silver Group website and complete the requirements to show you are an accredited investor. The service is free if you choose to use it, or you can provide a certification letter of your accredited investor status from your own CPA or attorney. This way, we don't ever need to see your financial information. Fourth, complete a subscription document, preferably within the portal provided, or as another option, you can print the forms, sign them, scan them, and then upload them to the portal. Remember, if you're using retirement accounts, grantor trusts, you will need to plan on having your account custodian review and sign off your investment. Fifth, and finally, once you have reviewed our subscription and have ensured that its compliance requirement, once we have reviewed your subscriptions and ensure that the compliance requirements are laid out and the documents have been met, then we'll let you know, and then we'll ask you to wire your funds at that time. And look forward to having your investment grow. So I want to thank you. We're excited about this marina space and making this offering available. In summary, the marina market is still in its early stages of consolidation, and we expect it to provide high yields over the next few years for investors that get in the game now. We continue to work with larger funds and are working to provide optimized portfolios for their consideration. We expect about a 5-year window of very little competition as middlemen, and then things should begin to compress. Hopefully, we've provided you the information you need to give the space some serious consideration, and hope you'll give us a call or email us. Thank you again for taking the time to review this presentation. Please visit us at southsilvergroup.com, scan the QR codes, whatever you choose. This slide deck is available. We'll have source references also in that slide deck if you're interested. And we look forward to answering your questions and assisting you in joining us in this exciting investment opportunity in real estate. Again, thank you. And please reach out to investing@southsilvergroup.com with your questions and let us know when you're ready to take this adventure. Thank you.